Picture this. You've just set aside $100,000 to invest in the stock market. You're staring at two options. Fidelity says, we'll manage it for free. Vanguard says, we'll only take a tiny fee, but we've been doing this since the 1990s. Which path do you choose? Now, fast forward 30 years. How much is that single decision worth? Even the smallest percentage difference can quietly compound into thousands of dollars. But here's the catch. When something looks free in investing, the real question is whether it truly is. Fidelity made headlines in 2018 when it introduced the Fidelity Zero Total Market Index Fund, known as FZROX. For the first time, investors could buy into a fund that tracked the Fidelity U.S. Total Investable Market Index without paying a single cent in annual management fees. This wasn't just unusual, it was a shock to an industry where even tiny expense ratios had long been accepted as part of the cost of investing. Suddenly, new investors could access broad market exposure with no visible fee dragging on their returns, and it's no wonder this announcement drew immediate attention. But removing the fee on paper doesn't erase the reality that running a fund still costs money. Even simple index funds require administration, legal compliance, accounting, and technological infrastructure. So, if investors aren't paying those costs directly, how does Fidelity make it work? The model looks a lot like the freemium approach seen in other industries. Just like a free app might earn money through ads or upgrades, Fidelity has other ways of turning a zero-expense fund into a profit without ever sending you a bill for FZROX itself. One method is securities lending. Fidelity can loan out shares within the fund to short sellers or other institutions and collect fees or interest in return. Another is cash management. The moment you receive dividends or make a deposit that sits uninvested, Fidelity can put that idle cash to work for itself and earn interest. Even seemingly small balances left sitting can translate into significant revenue across millions of accounts. And then there's cross-selling. By opening a Fidelity account to buy FZROX, investors are more likely to use the company's retirement accounts, financial planning services, or brokerage tools, products that do carry costs. In this way, the zero-fee fund becomes an effective entry point into Fidelity's larger business ecosystem. To see this in action, picture someone opening an account with literally just a few dollars. Thanks to FZROX's $0 minimum investment requirement, they don't need large sums to get started. They can brag about avoiding fees, and that's true in the narrow sense of the fund itself. But every dollar they leave uninvested still generates income for Fidelity, and over time they may expand into paid services. What began as a zero-fee entry quickly becomes a long-term, profitable customer relationship for the company. There's also a subtle point many investors overlook. These zero-fee funds tend to distribute slightly lower dividend yields compared to alternatives like Vanguard's VTSAX. The difference is typically small, but over decades it compounds. That means free can still carry opportunity costs you may not notice immediately. Still, performance-wise, FZROX has delivered competitive results in its short lifespan. By late 2023, for example, it had returned 14.19% year-to-date and 15.94% over the prior year, numbers well in line with what you'd expect from a total market index fund. For investors evaluating it purely on return so far, the product has worked as promised. What makes the offer especially appealing is how easy it is to access. With no account minimums and no fund-level fees, Fidelity removes some of the biggest barriers facing new investors. For someone just starting out, that can feel like a huge advantage. And for many, the psychological benefit of seeing 0% under expenses is enough to create confidence in choosing it over competitors, even if the revenue comes from less obvious places. On paper, then, Fidelity seems to offer a deal that's hard to beat. Yet the story doesn't end with zero. Costs may exist in forms you can't see, and more importantly, Newer funds like FZROX lack the long track record of others in the industry. That's why so many investors continue to weigh a choice between the excitement of a no-cost newcomer and the reassurance of a provider that has been tested over decades. And that choice brings us to the next question. What really matters more in the long run? A bold new promise or 30 years of proven trust? When you look at Vanguard's track record, you're not just seeing a fund. You're seeing 3 decades of steady commitment to investors. Vanguard's Total Stock Market Index Fund, known as VTSAX, has been around since the 1990s and is built to track the CRSP US Total Market Index. That means it doesn't just cover big, well-known companies, but thousands of businesses across the entire US market. For many investors, it feels less like one option among many and more like the reliable foundation of a portfolio. Scale tells its own story here. By the end of 2025, VTSAX held over $2 trillion in assets under management and more than 3,700 individual stock holdings. Compare that to Fidelity's FZROX with roughly $29.5 billion in assets and about 2,578 holdings. Both funds offer broad exposure, but Vanguard's reach is far more extensive, spreading across more companies and economies of scale that matter in the long run. This level of diversification is part of why so many investors keep their money with VTSAX for decades. Now, VTSAX does carry a 0.04% annual expense ratio, and it requires a $3,000 minimum investment for Admiral shares. At first glance, that feels like a strike against it. Why pay anything at all when Fidelity lets you in with no minimum and no visible expense ratio? The answer lies in what that modest cost actually supports. Vanguard's unique investor-owned structure means operating expenses aren't designed to deliver profits to outside shareholders. Instead, they go back into the fund's systems, reinforcing the very processes that protect long-term investor outcomes. Those processes include tax-efficient strategies and remarkably low turnover, about 1% annually. This level of discipline is not just a statistic. It translates into fewer taxable events for investors. Anyone who has faced a surprise capital gains tax understands how damaging those costs can be. By minimizing them over decades, Vanguard helps more of your returns stay exactly where they belong, with you. What seems like a tiny fraction of a percent is actually the backbone of an approach John Bogle, Vanguard's founder, designed to compound wealth more efficiently while avoiding leakages from fees and taxes. That stability has mattered most not in good years, but in the hardest ones. During the dot-com collapse of the early 2000s, tech-heavy portfolios fell apart, and many investors gave up altogether. VTSAX, like the rest of the market, declined, but it did exactly what it was designed to do: track the whole market, not swing wildly with one overheated sector. Again, in 2008, during the depths of the financial crisis, VTSAX lost value along with nearly every other investment. But its investor base had already witnessed its resilience through ups and downs, and those who stayed the course were positioned to capture the recovery. That quiet consistency is often the difference between investors who panic and those who endure. Imagine having $100,000 invested when the market crashes. Watching it fall to $60,000 can be gut-wrenching. In moments like that, the debate over a 0.04% fee fades compared to the confidence you feel in your fund's history and structure. For many, the long record of VTSAX is less about nostalgia and more about knowing that the systems, tax strategies, and diversification have already navigated storms and rebounded with strength. That's why calling the expense ratio a cost misses what it represents. For some investors, it feels more like a safeguard, a reinvestment into durability and consistency when conditions are least forgiving. Yes, Fidelity's promise of zero cost looks better on a spreadsheet, but Vanguard has 3 decades of evidence showing that a small, purposeful fee can reinforce long-term outcomes. Of course, all of this trust and history still leaves one practical question. How does it translate into results when real money is on the line? Let's put the numbers to work in what we'll call the $100,000 showdown. Imagine investing the same $100,000 into both Fidelity's FZROX and Vanguard's VTSAX today. To isolate the impact of fees alone, let's assume both funds grow at an identical 10% annual return before expenses. Of course, in real life, their indexes aren't exactly the same. FZROX tracks the Fidelity U.S. Total Investable Market Index, while VTSAX follows the CRSP U.S. Total Market Index. These slight differences in methodology and holdings can cause performance variations, but for this comparison, we'll strip that out and look at the cost factor head-to-head. After 10 years of steady compounding, Fidelity's investment grows to about $259,374. Vanguard's fund, after accounting for the 0.04% annual fee, ends up at roughly $258,339. That's a difference of just over $1,000. In the context of over $250,000, the gap feels almost trivial, more like a rounding error than a serious disadvantage. At this stage, it's easy to see why some investors dismiss fees as inconsequential. But the important thing to remember is that compounding never stops. Those small annual differences do not fade, they accumulate. Fast forward to the 20-year mark. Fidelity's zero-cost compounding lifts the account to about $672,750. Vanguard's balance rounds out to nearly $667,028. Now the difference is $5,722. By itself, that's not dramatic. It's less than 1% of the portfolio's value. But it illustrates how the once negligible impact of fees continues layering over time. While both funds deliver outstanding growth, Fidelity maintains a slight numerical edge strictly because of its zero-expense structure. Now extend the timeline to a full 30 years, and compounding puts the numbers in sharper focus. Fidelity's position grows to approximately $1,744,940. Vanguard's balance comes in at about $1,724,486. The difference between them now stands at $20,454. Suddenly, this isn't just a spreadsheet detail. That amount could pay for a year of tuition at a public university, purchase a used car, or provide a meaningful boost in retirement. It's not life-changing money in a portfolio approaching $1.75 million, but it proves the fee advantage has evolved into a tangible sum. Still, before you declare a winner, step back and consider the bigger picture. Over 3 decades, either of these funds has turned $100,000 into nearly $1.75 million, an outcome that vastly overshadows the fee difference by itself. Fidelity undeniably wins the fee race on paper, but Vanguard's 0.04% drag doesn't erase wealth. It trims it modestly. And while victory by Fidelity in dollars is clear, Vanguard's long-established structure, proven strategies, and reputation for investor advocacy aren't accounted for in these numbers. That's the real takeaway of the showdown. Fees matter, but they're only part of the equation. Saving $20,000 over 30 years sounds meaningful, but the real wealth engine is staying invested, weathering downturns, and letting compounding do its work. Both funds accomplish that job. They both grow your money to life-changing levels, even if one edges slightly ahead on paper. So once the math is clear, the remaining question shifts away from percentages and compound growth formulas. The real decision has less to do with which fund shows a bigger number after 30 years and more to do with who you are as an investor, what stage you're in, and what kind of investing partner feels right for you. Choosing between Fidelity and Vanguard isn't only about crunching numbers. It's about how each fund aligns with your situation right now. Your decision carries different weight depending on whether you're just starting with a few $100s or managing years of accumulated savings. Once you look past fees and long-term growth charts, what quickly becomes clear is that Fidelity and Vanguard seem designed for two very different types of investors. For someone beginning their investing journey, accessibility often matters more than track record. Imagine working hard to save a few $100s only to discover many funds won't even accept you until you meet a $3,000 threshold. That can make investing feel like a closed club for people who already have wealth. Fidelity deliberately removed that barrier by creating a fund with no minimums. With FCROX, even your first dollar gets invested, compounding right away rather than waiting in a savings account. This accessibility can make a huge difference because the earlier that money enters the market, the longer it has to grow. For a beginner, the psychological win of being able to participate immediately can be just as powerful as the financial one. Vanguard, on the other hand, positions itself differently. VTSAX requires a $3,000 minimum to invest in its Admiral shares, the class most investors associate with its low costs. For someone just getting started, that might feel like an intimidating hurdle. But for an established saver, it's barely a consideration. If you've reached the point of having tens of thousands or more already invested, the minimum is no issue. What matters more is knowing your money sits in a fund with a 30-year track record of guiding investors through every kind of market cycle. Though you're paying a 0.04% fee, seasoned investors often view it not as a burden, but as the cost of confidence. Confidence in the fund's structure, confidence in its commitment to low turnover and tax efficiency, and confidence in Vanguard's reputation overall. Think about the contrast through two examples. A recent college graduate has scraped together $500 after a summer of working. Vanguard shuts the door on VTSAX until they hit the $3,000 minimum. But with Fidelity, they can invest instantly, and their first investment starts working for them right away. On the other end of the spectrum, picture a saver in their early 40s who has diligently built up a $50,000 portfolio. They aren't worried about whether they can add a few $100s tomorrow. They're thinking about where large sums can sit safely for decades. That person may happily accept Vanguard's small fee, valuing its history and scale as reassurance during market downturns. Both approaches can produce wealth, but they cater to different needs. It isn't about declaring one fund superior, it's about aligning the choice with your resources and priorities. Fidelity gives first-time investors a low-friction entry point. Vanguard gives established investors the credibility of a giant global fund with trillions under management. To put it simply, choose Fidelity's FZROX if you're a new investor with limited capital, you want to minimize cost entirely, and you're comfortable with a younger fund that doesn't yet have decades of history. Choose Vanguard's VTSAX if you have at least $3,000 available to invest, you value consistency and stability in a widely trusted fund, and you're willing to pay a very small expense ratio for long-term reassurance. At the end of the day, both paths harness the same power of compounding over time. The key is less about comparing decimals in annual fees and more about selecting the fund that fits where you are in your journey. Starting early, staying consistent, and sticking with your choice matter more than any theoretical edge. And that leads to the bigger perspective, the part of investing that numbers alone can't capture. Fees may matter, and track record may matter, but what makes the biggest difference is starting early and staying disciplined. Building wealth is a marathon, not a sprint. Time in the market consistently outweighs trying to find the perfect fund. Your $100,000 can become something life-changing only if it's invested and left to grow. Think about your own situation, how much you're starting with, how comfortable you are with risk, and what vision you have for the future. Give this video a thumbs up and subscribe for more, share it with a friend, and let us know in the comments below which fund are you leaning toward, Fidelity or Vanguard.